All right, I want to bring in our friend Bianco Research President Jim Bianco. Jim, I'm using your NASDAQ 100 chart to illustrate, again, how fantastic this was. I mean, this is the best start ever for the NASDAQ 100. Just mind-boggling. Obviously, no one expects this to continue, but I do think of Sir Isaac Newton, right? The first law of motion states that a body at rest remains at rest unless an outside force acts upon it. And a body in motion, and this is definitely in motion, a constant velocity will remain in action in a straight line. This is certainly a straight line until acted upon by an outside force. So when it comes to this rally, what's the outside force? What's that going to be that stops this rally?
Well, I think it's going to be the typical things of the economy, inflation, interest rates. And you could actually, Charles, we could also argue the other side of that coin, too. You show the NASDAQ 100, which is almost 50% of it is 7 stocks, the big FANG stocks plus NVIDIA, and the rest. The other stocks are not doing anything. They're doing very, very little. In fact, they're performing in line with cash. And one of the reasons why they're performing in line with cash is that uncertainty about the outlook for the economy, interest rates, and inflation. And if that situation worsens, I think then it can filter through to the upper stocks. But you're right. If we continue on this perpetual, in 6 months, the economy is going to get bad. And then in 6 months, we say, in 6 months, the economy is going to get bad. The big cap stocks will continue to rally and the small cap stocks will continue to meander sideways.
Can there be a world where the big cap stocks sort of consolidate these gains, give up a little bit, maybe 5% or something like that, and the rest start to come on? Buyers start to look elsewhere.
Yeah, I mean, that's always possible. But typically, every correction is a function of the previous advance. So if the market is up in some of these stocks like NVIDIA and Tesla are up more than 100% in the first 6 months of the year, you don't consolidate 5%. You consolidate 25 or 40%, somewhere in that range. Right. And then you continue to move higher, only because the previous advance was so big. So, yeah, that's possible that they could train sideways and that the rest of the market, the troops can catch up with the generals. But usually when they do correct, it is a bit of a thrill ride.
Jim, I want to ask you about the bond market. These bond yields have been surging like crazy. I think they're flashing at least yellow flags. And you have a great chart out there. Everyone should, by the way, if they're not following you on Twitter, they must. And showing sort of the historic relationship between real total returns for the stock market and the 10-year yield. So we know last year was really awful, right? So the stock market was off, the bond market was off. Where are we on this chart now, though? I mean, where would we be? Because it feels like the stock market and now the bond market, to a degree, are they decoupling or recoupling? What's happening here?
Well, right now, if we were to update that chart, you're right that last year was such an outlier year that it's moved back into the upper right quadrant where it should be. But yes, to your larger point, is the stock market and the bond market possibly decoupling? There is an open question to that because as interest rates continue to move higher from here, you would think if it was like last year, that should weigh on the stock market. Now, maybe it does in the second half of the year, but so far it has not. And I'd even drill it one step further. Remember, all last year, we kept saying that it was higher interest rates that was killing all the tech stocks. Yeah. And now we've got even higher interest rates and they can't go up fast enough right now. So. Yeah, that's usually the way it works on Wall Street. Yeah. So, I mean, we could be decoupling.
Yeah, you change the calendar and all of a sudden the rules change. Jim, I'm over time, but I got to squeeze it in with you. I have to. I had Jim Grant on Friday. He said he kept talking about the bond bear market. Almost anyone watching this never lived through it because it ended in 1981, but it began in 1946. Are you concerned we could be entering a secular bond bear market?
I'm right with him. I think it began in 2020. And I think we're in a period of many, many years of higher interest rates. Maybe not higher this year or next year, but if you look out over 5 or 10 years, that we're going to see much higher rates. Gone are the years of zero interest rates as far as the eye can see.
Wow. Jim, great stuff. Thank you so much. Always appreciate you and your great work. All right, folks, let's bring in Market Gauge Managing Director.